I'm Anton. I work in Bereke Bank as a data scientist. We work mostly with risk models, and now we're experiencing some, say, data shifts, and we need to monitor our models better. So I was inclined to do some research on model monitoring and found out some interesting stuff with NanoML. It's all good. So let's start with practical examples. And here is the first one. We were developing a credit risk model based on credit history. And during the development, we noticed that the model's metrics were degrading in time and dropped down on out-of-time data set. This is shown on the slide here. This out-of-time data set is usually used to validate the model's performance, while in-time data sets is divided to train and test to fit a model. First, we measured univariate drift metrics such as Jason-Shannon distance and population stability index as well. And these measurements indicated that several features exhibited significant data drifts on out of time, coinciding with the period where our metrics began to drop. Examples of these features are shown at the bottom of the slide here. And to investigate further, we measured multivariate data drift using PCI reconstruction error. It's shown here at the bottom of the slide. And this metric also revealed significant drift on out of time during the same period, indicating that the model was likely affected by some sort of population shift. But was the observed effect solely due to the drifting features? That's a good question. Let's explore this. Do you have any suggestions on which features we should consider dropping? Please share your ideas in the chat, and I'll be waiting. We have 4 examples of features here: feature 1, feature 2, 3, and 4 with a couple of alerts. So please write your ideas in the chat. Okay, feature 3, feature 2. Any other ideas? Surprisingly, feature 1. Okay, 3 times. 3 votes for feature 1. It's surprisingly. Okay, that's nice. Feature 3. 3 and 4. It looks logical to drop these 2 features, 3 and 4, as they have alerts. And actually, in fact, we tested dropping all the drifting features one by one, but it didn't resolve the data drift or mitigate its impact on the model. Interestingly, these drifting features were critical to the model as their significance was quite high. So it didn't work. How did we solve the case? Well, first of all, we started to drop every features in the model one by one while measuring multivariate data drift by PCI reconstruction error. Why is this? Because as we know, the model doesn't operate with features themselves in isolation. It works in a multidimensional space, and it works with all the features simultaneously. And this to address this, we use our different approach to drop every feature, every possible feature in the model. That's how we did, and we found one feature whose removal significantly reduced the PCI reconstruction error, and it was feature 4. As you can see here, the feature has no drift at all. It looks absolutely stable, but its impact on the multivariate drift of the model was crucial. And what is more interesting that this feature importance was quite low. So we keep better features in the model while dropping the sort of unusual one. What this story teaches us? It shows us that when we use multivariate drift as a metric of the drift itself, instead of using univariate drift with particular features, we have a better approach, and it's a highly powerful method to make our models better. So what's the result? We can see Gini metrics here before and after an action. So Here we see that our Gini rises up to, say, 61 points instead of 55. It's actually not an initial value of 65 and 67 points, but not that bad. Okay, let me explain the idea of the CBPE tool. Imagine you have a classification model running in production, but you lack access to the ground truth labels, making it impossible to directly calculate performance metric. How can we estimate the model's actual performance in such a case? Well, model predicts a class and a probability for every object. The probability shows model certainty regarding each object. Let's follow Dr. Strange then and think of each prediction as representing a potential outcome in the multiverse, supposing it exists. For example, let's consider the object 3 here, which the model classifies as negative with a probability of 40% for the positive class. They suggest that in 40% of the case, the object 3 would appear positive, which means false negative rate. And in the remaining 60% of the cases, it would appear negative, true negative rate. Let's write this down to the table and do the same for the other objects in the sample. This table essentially resembles confusion matrix. Let's show it graphically to better understand the concept. We can represent the model certainty values for each object with lines. In this slide, green lines represent true positives, red lines represent false positives, blue lines represent true negatives, and yellow lines represent false negatives. Next, we calculate the confusion matrix for the given threshold by summarizing the length of these lines. So now we can move the threshold and make the same calculations gaining an integral matrix such as ROC, IOC, for instance. This gives us an estimate of the model overall performance, which can be then used in analysis and decision making. But what are the methods constraints? First of all, we don't actually have access to the multiverse yet. The best approximation to this concept is looking at predictions which are close by model certainty to the interested ones. This means binning of probabilities. Therefore, the model's predictions must be calibrated. This means the predicted probabilities must accurately reflect the true likelihood of outcomes. Another critical constraint is that the data must be free from any concept drift. If there is one, method doesn't work. We don't go deeper here with the calibration concept, but it can be discussed in Q&A session. And now, here is another practical example. We were working with a classification model in production that lacked ground truth labels, making it impossible to calculate performance metric in real time. Normally, it would take us about 12 months or even 15 months to gather the necessary data to calculate the model's performance. In development, model appeared green, delivering overall growth ROC-IOC around 83 points. However, starting in October 2022, the model exhibited significant changes in the predicted default rate. This is usually an alert flag. Also, we didn't have good data within the period of summer 2022 due to process changes. Let's have a look on the second plot here, where we measured PCI reconstruction error over the same periods. What we see here is significant multivariate drift over the period of end of 2022 and later, especially here. Given the context, let's turn our attention to the CBPE results. And here we can observe the results over the specified periods. Notably, there are a couple of alerts towards the end of the period here, indicating an expected drop in metrics. Additionally, we can see that the metric behaves unexpectedly during the gap period. In our case, this is likely due to the insufficient number of observations, but generally, it could also be a sign of model instability. So based on these findings, we made the decision to rebuild the model without waiting for the usual rebuilding cycle. And now the question is, was that decision the right one? Well, we remained patient and waited for a year to compare the calculated metrics with the actual performance. Looking at the results, it's clear that the algorithm detected the decreasing trend in metric, not from very beginning, but significantly sooner than 1.5 year delay. Given the absence of new data for an expected period, had we relied solely on waiting, we would have identified this decline far too late. In retrospect, the decision to rebuild model early was absolutely right and timely. Taking the data gap in consideration, we didn't have a lot of new data to use, but we decided to buy external data. In the result, we built a new model using all available data with increased ROC up to 81%. It's not the initial value, but it's way better than it might have been without an action. And despite validating our previous decision, we continued to monitor the CBPE estimation trend closely, and the trend appears to be declining, indicating that another model rebuild may be necessary in the near future anyway. So thanks to CBPE tool, we were able to anticipate this potential issue much earlier than we would be otherwise. Finally, the last practical example. In this example, we once again have a model in production without access to ground truth targets or performance metrics. However, this time we are dealing with a regression model, more specifically a time series model. The primary model is built using linear regression due to regulatory constraints, but there are no constraints about the monitoring model. So the daily model is based on boosting. In this graph, the orange line represents the normalized prediction of the primary model, while the blue line reflects the true values, which we only get to see much later. Let's focus on the two peaks on the right side of the graph. Notice how model missed the second one. This peak was caused by a process change, and additionally, there is a growing trend towards the end of 2023, which the model also struggles to capture. This isn't surprising given that the model hadn't seen anything similar before. But now let's take a closer look on what the monitoring model showed us during these periods. In the first plot, we see the model's real absolute error represented by the green line and the DLE predicted metric by the red line. The DLE successfully detected the process change that led to the new peak here, and it also revealed a growing error trend towards the end here. This early warning highlighted the silent failure of the model, driving us to rebuild the model earlier. This rebuilt model delivered better performance, reducing RMSE by 25% at the new out-of-time period, which includes the observed new trend. So, what's in conclusion? How advanced model monitoring methods help us? In the banking sector, where we often don't have access to the ground truth for up to a year or even longer, advanced monitoring methods are invaluable. Data drift analysis, precisely multivariate data drift analysis, allows us to monitor the new data in multidimensional space, identifying potential risks in both development and production cycles. Confidence-based performance estimation provides metric estimations and early warnings of silent failures for classification models, while direct loss estimation serves a similar function for regression models, detecting process changes and highlighting error trends. Together, these techniques significantly enhance our monitoring processes, helping us mitigate credit risks more effectively. So that's it.